Hey everyone, welcome back to the channel. Now for this week, what I want to do is take you through one of my subscribers' question that she sent me on email about whether she should be selling her Vancouver condo or not because she's about to make a lot of moves. And this is not going to be from a real estate price perspective, but more from a financial planning perspective. I will be showing you how I break it down for her and my thought process so you can follow along and maybe do the same thing for your own situation as well. Now, before we start, if you haven't already, make sure you help us hit the like button. This is going to help us with the YouTube algorithm. And also join our free private Facebook group if you haven't already. We have about 5,000 members in there. The link to join is in the description below. All right, so let's jump into it and let's see her situation. Basically, this is a situation on hand. She's a physician based in BC right now, looking to relocate from BC to Ontario this year. Has a property near her work in BC and also a condo as a rental in Vancouver. She pays herself $10,000 per month as income from her medical corporation. Now, she also has $68,000 of line credit on the side, where she used for renovations, medical school loan, etc. And this is sitting at 6.45%. Now, her main concern is if she should be selling her Vancouver condo or not, and if she does sell it, does she want to use the money towards RSP and also maybe pay off the line of credit and use the rest for her Ontario home? Now, when it comes to these kind of questions, you should always start with listing out all the information you know, maybe on an Excel, just so you can kind of map the situation first. The Vancouver condo tenant has just moved out, so it's empty right now. She bought for $325,000, likely can sell for $590,000 today, and she owned it for 13 years. There is $140,000 of mortgage remaining at 5.45 variable rate. She's making a bi-weekly payment of $572 per month. Rent can go up to $2,000 a month according to her realtor. Property management fee, if she does rent it out, is going to be $100 per month. Condo fee $367. Now, utility and internet is not specified here, and I'm not sure if it's gonna be her responsibility or not, so I'm just gonna leave it blank for now. Some more info about the condo. She just replaced faucet last year. She is expecting to replace dishwasher in 5, washer and dryer in 10. No special levy on the condo anticipated for the next 5 years for now. Alright, so that's all the info she's given me. So my question to you would be, should she be selling or not? Now, I want you to think about your answer real quick and see at the end, do we have the same conclusion or the same thought process? So our first step here is to lay out all possible scenarios that she gets to choose from. And in general, there's really 3 major ones. First one is she sells it, she used the proceeds for RSP, pay off the line of credit, and use the rest for her Ontario home. Second scenario, she sells it, she funds her RSP, but she does not pay the line of credit. And you notice that I'm assuming she is going to do RSP regardless, because by selling her property, we'll see later on, she'll be sitting at 45 and maybe even a 50% tax rate. So doing RSP does give her a lot of tax savings, so it makes a lot of sense here. Now, the last scenario will be she does not sell it and she keep it as a rental. Now, knowing all the scenarios, the last step would be to map them out as numbers and put it on a chart so it makes more sense. So for the first scenario where she sells and she used for RSP and line of credit, this is what we're looking at. In this hypothetical calculation, we can see that the total cap gain is $244,000. But in the email, she mentioned that she lived in there for 6 of the 13 years. So only a portion of the $244,000 is taxable. Now, in practice, what she would have done is either when she was moving out, hire a third-party appraiser to get the fair market value, or today, backtrack and try to get that value, get that estimation to really calculate what cap gain she actually has to pay for the part she's renting it out. But as a quick calculation here, I'm just going to be using a straight line method. And keep in mind, we also has a +1 rule when it comes to principal residence exemption. What that means is, as any given years, you can actually own 2 principal residences. This is to facilitate for people that have to buy the next property before they can sell the previous one. So after adding 1 to her principal residence exemption years, 46% of her cap gain should be counted as taxable, which works out to be $112,000. And at 50% inclusion rate, half of this is to be added to her income and counted for tax purpose. Now, since she pays herself $120,000 per year from her corporation, I'm assuming a salary here, this is what her tax would be looking like before and after this taxable cap gain. So we can see that by selling her property, she has to pay about $24,000 in additional tax. Now, taking her sale price minus the commission, lawyer fee, mortgage owed, estimated cap gain, this gives us a remaining cash on hand of about 300 something thousand. Now, with all this done, we can cover scenario number 1 and 2. We take her cash on hand minus RSP, and maybe we'll minus the line of credit. Now, we have to add back the capital gain in this case because by buying exactly $56,000 of RSP, this negates the capital gain she would have to pay otherwise. this will give us the remaining left on hand for her Ontario home. Now, whether she should actually be paying off her line of credit or not, we're going to be talking about this on the next part. Before we do that, let's look at what if she doesn't sell the property. Now, not selling is actually quite simple. She's simply going to keep it, collect rent, and pay all the expenses. So I've done a chart to lay out the cash flow. And as you can see here, if we do not count internet and utility, she's probably exactly break even at $2,000 per month rent. But if we add those things in, she's likely going to be negative per month. However, keep in mind here, this negative is her total cash flow overall. Part of her expense is actually her principal payment, which is about half of her mortgage payment per month. It means that she's not actually negative if we just count the expense and ignore the principal payment. But what it means is every month, out of pocket, she has to fund some money and put it back into the house as principal, as saving basically. And this is important because it means keeping this property does not give her any positive cash flow that she can use towards her principal mortgage payment in Ontario. And this actually plays a huge role on her tax planning, which we'll talk about in the next part. So next, let's go over some questions or concerns we may want to think about before we make our decision. Now, the first consideration is by not selling our rental property for the $300 to $350K cash we could have on hand, do we need that money from the Ontario home? If we actually needed that money and we don't have it, we would have to borrow it from the bank. Now, because we're doing this around summer, I can safely assume we will be hovering about 5 to 6% interest rate at that time. And also, this is not tax deductible. This payment is going to look around a $2,000 extra per month for this $300K-ish borrowing. And because rent should be slightly negative or neutral, there will be no help there. And she's already paying herself $10,000 per month. I'm assuming she used all that for other stuff. She will have to take an extra $3,000 on top before tax just so she can pay income tax and have enough left to pay that extra mortgage payment per month. So this translates to about $35,000 to $40,000 of extra annual cost she has to take from her corporation, where she could have kept this money inside her corporation, pay a very low after-tax corp dollar, and continue to invest this in her accounts. So the question would be, is the cost justifiable looking at the growth of the downtown property? Now, on top of that, another thing to consider is, can we even qualify for that much more mortgage, looking at the fact that we have a Ontario home mortgage to get, a condo mortgage we're keeping, and also her BC home she's staying in right now likely has a mortgage as well. Now, this might be very difficult to achieve in this rate environment, despite the fact she's a very high income earner already. Now, the third thing to think about is, does she want to deal with all these out of province tax filing and potentially property issue, even though there's a management company, but if big things happen, she still may have to fly back and deal with it. Does she want to do all that, or she just want to keep things simple? Now, lastly is special levy. I know she said it's not a concern in the near future, but it can still happen, especially the fact that she already kept this for 13 years. If it is not a brand new property, then it may be older than 13 years. So it could come at any time as a surprise. Can we handle this issue, and where is the money coming from? It would be not very advisable to sell our investment to fund these things. We'll probably have to use a line of credit. If we're going to do that, we should grab a home equity line of credit on top right now just to get ready. But then again, this feeds into the issue, can we even lend that much at today's rate environment? So with all these considerations, I think selling the property is the more obvious and the easier choice in terms of financial planning. It just helps facilitate and remove a lot of the concern, letting her to focus on her new life in Ontario. So let's assume we're doing that. Next, let's move on to, should we be paying off the line of credit or not? Now, the first concern will be, is the line of credit payments tax deductible? Because it sounds like it's only partially is. According to her email, it's used for various different things like medical, school loan, renovation, etc. And this brings us to the second concern, because if it is all bundled together and only some of these things are tax deductible, she should break it up into small parts of line of credit so she can accurately track how much interest each part is generating and which ones are tax deductible. Or else, if one day she gets audited by CRA, she's going to come under a lot of scrutiny for this part. Now, for the tax deductible portion, the interest rate is actually not that bad, even though it's at 6.45% right now. Because it is tax deductible and her income bracket is around the 40%, her real tax rate is hovering around 3.8 to 4%. This is a relatively cheap loan that she can keep, because on the other hand, she could have used that money and generate a higher return. But for the portion that is not tax deductible, she should probably pay that off because it is generating her 6.45% return every year. And last consideration is paying down line of credit also lowers her monthly minimum payment, which will help tremendously when it comes to applying for mortgage for her Ontario home. Now, as a side note, also one thing I brought up to her, if she's just looking to negate her capital gain tax, she does not have to put full 100K into her RSP like she planned before. 56K, as we've seen before, will already do that. If she wants extra tax refund, or she just want to make use of the tax shelter to start early, then she can fund the full thing. However, the fact that she's moving to Ontario home and getting a mortgage there, for this I'll advise her to keep more money on hand first and not fund the whole RSP yet, just in case she needs to use that money for extra down payment. Alright, so that's everything I took her through and my reply to her in the email to help guide her to think about what decision she wants to make. Next one I want to hear from you is, do you agree with everything we just said? Or is there something we're missing and not considering? Let me know in the comment down below. And also, if you like these kind of videos, we do upload them every 2 weeks right now. So make sure you hit the subscribe button, click the bell button so you get all the notifications in the future. Alright, this is Jackie Ko. I hope you liked today's video. I'll see you in the next one. Bye!